Income attribution rules. Tired of seeing a huge chunk of your income disappear to taxes while your spouse or kids sit in a lower tax bracket? What if I told you there are legal ways to shift that income and reduce your family's total tax bill? Well, there are, but only if you know how to navigate Canada's complex attribution rules. Welcome to the channel. My name is Anthony Gismondi. I'm a senior wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. Today, we're diving into something every high-income earner or family-focused investor in Canada should know about: income attribution and income splitting. We'll cover what income attribution is, when the rules apply, how to split income legally, and key strategies to reduce your family's overall tax burden, including one area many people overlook: spousal RRSPs. Section 1. What is income attribution? Income attribution rules are designed to stop income splitting abuse. They prevent high earners from gifting, transferring, or lending assets to a spouse or common law partner or minor child just to lower the family's tax bill. In essence, if you transfer, gift, or lend assets that generate income, the CRA may still tax you on that income, even if the asset generating that income is technically in someone else's name. Section 2. When do attribution rules apply? Attribution rules commonly kick in when you gift, transfer, lend money to your spouse or a minor child and they use it to invest. You transfer property to a trust with your spouse or minor children as beneficiaries. Certain situations where you lend money to closely held private corporations. Section 3. The prescribed rate loan strategy. There's one major workaround: the prescribed rate loan strategy. If you lend money to a spouse or a minor child at the CRA's prescribed rate and they pay that interest annually, you avoid attribution. The investment income gets taxed in their hands, often at a much lower marginal tax rate. It's simple in concept, but timing and paperwork matter. Interest must be paid by January 30th of the following year, every single year. It's also very important to note that the transferor must report the interest income on the tax return, and the transferee has the ability to deduct the interest paid against the investment income earned. Section 4. Attribution and spousal RRSPs. Now let's talk about spousal RRSPs, where attribution can still apply, but also be avoided. A spousal RRSP is an account registered in your spouse's name, but you, the higher income partner, make the contributions. You get the tax deduction now, and later your spouse withdraws the funds, ideally when they're in a lower tax bracket than the higher income spouse. But here's the important part. Withdrawals are attributed back to you, the contributor, if a contribution was made in the year of withdrawal or either of the two preceding years. So, if you contribute in 2025 and your spouse withdraws funds in 2026 or 2027, you're on the hook for the tax, not your spouse. However, withdrawals in 2028 or later, those are taxed in your spouse's hands, which is the whole point of the strategy. Exceptions. This attribution back to you might not apply if you are living separate and apart due to a breakdown of marriage or common law partnership, you or your spouse has passed away, one of you is no longer a Canadian resident, and one more tip: spousal RRSP contributions can continue after death. An executor may contribute on behalf of a deceased person within 60 days of year-end, as long as it's within the remaining contribution room. Section 5. Real-world attribution scenarios. Let's walk through some practical examples. Juliet gives $50,000 to her adult child who's age 21 to invest. No attribution. The child is taxed on the investment income. She gives $50,000 to her 16-year-old. Interest and dividends are attributed back to Juliet, but capital gains are not. That part is tax effective. She loans $100K to her spouse. No interest. Attribution applies. But had she used a prescribed rate loan, attribution could have been avoided entirely. She contributes to a spousal RRSP, and her spouse waits 3+ years to withdraw. No attribution, exactly what you want. Section 6. Other income splitting tactics that still work. Beyond RRSPs and prescribed rate loans, here are a few more tools families are using. Family trusts with proper setup. Pension income splitting, up to 50% after age 65. CPP pension sharing based on the time lived together. Paying a reasonable salary to a lower income spouse or children for work they actually perform for the business. Having the higher income spouse pay the household bills. Higher income spouse contributing to lower income spouse's tax-free savings account. All legitimate, all CRA approved if structured correctly. The conclusion, structure matters. So does advice. Income attribution rules are complex, but with proper planning, you can split income legally and reduce your family's overall tax bill. The key is knowing where the landmines are, how to avoid attribution, and how to take advantage of tools like spousal RRSPs and prescribed rate loans. But don't do it alone. Consulting with a wealth advisor and tax professional can help you execute these strategies safely and successfully. If this video helped clarify attribution rules, give it a thumbs up and subscribe. Thanks for watching, and I'll see you in the next one.